Hi guys, welcome. We're here with another chat with traders. I'm here with Erik from the esInvests channel, and I will link his channel in the pinned comment and also in the description. And for people on Erik's channel, my name is David Jaffe, and I'm with Best Stock Strategy. And I want to go over, we're going to discuss like options trading and our mutual experience and common mistakes and things of that nature. This is going to be a very valuable chat. So kindly watch until the end and leave a comment below and let us know any questions that you have and any valuable feedback. I think it would be worthwhile if we started with our backgrounds. And Erik, if you could also like introduce yourself, your channel as I did quickly previously, but introduce like your channel and also your background, and then I'll do the same afterwards.
Yeah, for sure. That sounds awesome. So first off, thanks for putting this together. I
Mhm.
really enjoy these kind of conversations. They're always fun to me to explore, different approaches and different ideas. So I appreciate you kind of starting the dialogue there. But yeah, my name's Erik. I am a 16-year retail trader. I started back in 2007 when I was in high school. Like most people that started trading, I grew up super poor. I had a single mom and I was working a bunch of odd jobs, split wood, worked at a bowling alley, all that kind of stuff, like most of us do. And I had a teacher in high school that saw that I was working a lot and he was asking what I was doing with my money because he knew my background, he knew my brother. And I essentially just told him I was saving. Like I didn't know what else to do. And he's like, you need to look into investing. And that literally that one sentence sent me down a completely different life trajectory. So I started learning about investing. I went up to the library, first read books, then I started checking out on the computer. And long story short, I came across options after I traded equities for a little bit and I saw some early success. I was super fortunate and I started realizing like, oh, like this can actually make a difference for me. And I kind of kept at it. So even when I went to my undergrad, which was very statistics heavy, I started integrating a lot of that into what I was doing. And then even when I was on active duty in the Marines, I was a Marine officer for 6.5 years. I kept trading. I just kind of kept modifying what I was doing. And during that time frame, I came across a retired Army guy online, actually, that became like a huge mentor of mine. He never asked for anything. He never sold me anything. We didn't care. He literally was just helping me. And it's because I was taking the time to probe him. I was taking the time to learn, and he was willing to facilitate that. So, fast forward now, I'm 32 and I'm super fortunate the kind of life that I'm able to live. I pay for my mom's house, I pay for her expenses. And this all came from essentially two different people in my life sending me down a very specific path. So that's part of the reason why I like doing these so much, because I think the idea of just promulgating good, authentic information for people and not asking them for anything is massive because you never know what will click for them. So yeah, that's just a quick background on me. And then the YouTube channel, I started that back during COVID on the same exact line because I don't belong on a camera. I have a face only a mother can love. I'm not good at editing. Like, I'm not good at any of this. But I felt compelled because I had people that helped me anyways. So, long story short, all of my Marine friends, they were stuck at home. They weren't going on to base because of COVID. So, I always talk about impactful things to my life to try to help share information. And I found myself doing these phone calls with my friends about finance. And I was just saying, the same shit over and over again. I was like, you got to have an emergency fund. What's an emergency fund? 6 to 12 months of expenses, da 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 da. So, anyways, I made a couple videos and I said, here, watch this video so that when we talk on the phone, it's more productive for everybody, right?
Right. So you're not
And
repeating everything, right?
exactly, it's not a good use of anybody's time. And then the video started randomly getting views, and I was like, this is super weird because it was like recorded from a laptop. I think I was wearing a tank top, like it's just going for it. And the channel's kind of slowly been growing ever since, and I'm here for it. I don't really have any specific objectives for the channel, although I like to get better at things, and I'd like to think that I've gotten far better at this than when I started. I can't help but want to improve, but overall, my main objective is to share information. So yeah, that's where I'm coming from.
One thing that you said that I wanted to probe a little bit, you mentioned that you grew up very poor. What do
Mhm.
you think is the determining factor between, because I believe that like mindset and also work ethic is extremely vital between climbing up the social hierarchy and not feeling like you're a victim because you grew up poor, and still having faith in the system that if you worked hard, and you have value to provide other people, then opportunities will be provided for you. However,
Mhm.
from my experience, and I didn't grow up poor, but I actually grew up in a very poor area in Monticello, New York, in the Catskills. And
Yeah,
in
I'm
fact,
from Newburgh.
you're from where?
Newburgh, New York. So I'm from
Oh,
the Hudson Valley. I'm literally
that's
right
so
by it.
funny.
Yeah.
I used to have a girl. Okay, so I met a girl. Her name's Danielle in Poughkeepsie at like a nightclub, and then I used to go to Newburgh, like on the waterfront, and she had like a
Yeah.
jewelry store there. Her parents there, so I used to actually like date her, and I would drive like 40 minutes there. So and a lot of the. It's weird that you said Newburgh because some of the gangs from Newburgh have actually migrated to Monticello,
Hmm.
and now the high school is like significantly like more dangerous than it used to be.
Yep.
But but yeah, that's actually very
Dude,
ironic.
hilarious.
So what do you and I remember like the new we used to play soccer for like Newburgh against Newburgh Free Academy, and they would destroy us. Like you guys were amazing at soccer, like NFA.
Yeah, that's where I
But
went to
yeah,
high school.
actually, I actually didn't even know that you went to Newburgh. That's very but yeah, that's interesting. So I guess it's even like more relevant. Like what do you think separated you? Because I think both of us know like a lot of people who they didn't grow up wealthy, but they also had a lot of potential. You know, like they were very smart. If they studied at all, they would have gotten A's. They might have done naturally well on their SATs, but they still felt like a little bit angry at the world that they grew up like disadvantaged, or maybe they didn't have like the best clothes, or maybe they were picked on a little bit during high school. Why do you think you have like a positive mindset and you've been able to overcome like your like where you grew up and growing up poor to become the person that you are now?
I think it's two things. It's a great question too, because it obviously causes a lot of self-reflection. But I think the first part is I've never really allowed myself to resign myself to circumstance. And it's because I can't control circumstance. I'm a big believer in stoicism. I'm a huge practicer of it. So I think as a kid, my objective was to do as good as I can no matter what, and whatever happens will happen. I will be able to look at myself and say like I did my best. And I actually, that was one of the things that was super fortunate early on, is I got around a good crowd even in NFA, which was a pretty, I walked through metal detectors every day. Like it's not a good school.
Yeah.
And but I got into all honors classes, and it's because like I just wanted to do well. And then it's this kind of innate drive to perform. I am obsessed with performance. So I think that's the first thing. And then I think the second thing was good mentors, people that at a young age, because I had a dad, like I knew him, he was an alcoholic. He died pretty early, but he wasn't like the worst guy, but he also wasn't like a giant mentor of mine. He did mentor me, not to, take credit away from him. But one of the beautiful things about growing up with a single mom is that whole idea of like it takes a village is exactly what happened. My neighbors knew I didn't have a dad. So my neighbor across the street taught me how to snowblow in the winter. Then my uncle taught me how to work on cars. Long story short, the idea is, as all of these people understood my circumstance, they helped me. They helped me out of literally the goodness of their hearts. And I think that high school mentor of mine, I call him my stepdad now. He's like, I'm so close with him because he changed my whole life. And then that other mentor. So I think those are the two things. I think the first one is kind of worrying about what I can control and focusing on my own performance so that I can look myself in the mirror and say like I'm confident and comfortable with what I did here. And then the second thing is being receptive to input and having mentors that were willing to provide input. I think those are the two main things.
You also mentioned Stoicism, which I think is incredibly important. I love the quotation from Stoicism, like Marcus Aurelius, and I also subscribe to a bunch of YouTube channels. And in a way, it's like it's a little bit negative because you're kind of like pondering, like sometimes you're meditating upon your ultimate demise, and then you
Yep, your own
realize that
doom.
like everything that we do here is not super important. So in a way, it kind of brings peace to you when you think that something is so vital. But one quotation that I mentioned, that I was talking about earlier, is do what you can with what you have where you are. And I think that that's something that's incredibly important because puts you kind of similar to like what Eckhart Tolle say about like the power of now. Like with where you are right now, do your best with everything you have, like with all the information that you have at this specific moment. Like do what you can with what you have where you are. So essentially, do your best at this specific moment, and it kind of brings peace. And as long as you do that and you give 100%, then you don't necessarily have to be outcome dependent because you did your best based upon the information that you had available at that specific moment when you made the decision.
I literally love that. Like I literally love that. And I think that you highlight another really important part, which is, the idea of with the information that you have at that point in time. Because I look back and a lot of the ways that I've been able to navigate has been due to information injections from people. Exactly to your point. If that didn't happen, I literally have no idea where I would have landed. Like I wouldn't have gone to college because that same mentor is the one who encouraged me to apply for a Marine Corps scholarship. I wouldn't have gone that route. I probably would have enlisted, which would have been the best thing I could have done, to be honest. I think for people that grow up in slightly maybe disadvantaged positions, going through the military is one of the best possible things you could do, in my opinion, because it gives you a great structure. I've always liked structure, but it gives you like a really great network to immediately tap into and completely change your circumstance, which is funny. So you're from Monticello. Yeah, I obviously would love to hear about your background a little bit.
Yeah, so my dad was a doctor, and then he was an eye doctor in Monticello, and then my uncle was actually an eye doctor in Goshen, which is actually like closer
Yeah.
to you.
Yeah.
Yeah, like near like the Galleria Crystal Run.
Mhm.
And so I was in honors classes, but the classes, like our school was so bad that the teachers were almost expected to give us A's. So frequently, like during junior and senior high school, um, I would skip class and then go like bowling or like go to Walmart and things like that. And as long as I didn't get in trouble, then the teachers would still give us A's. And I did well on my SATs. I did go to a good school, and I think that the SATs they allowed me to get into Cornell. But the ironic thing is that even though my high school was so bad, I was so far behind all like the majority of the other kids at Cornell. But even though the high school was bad, it only took me one semester to catch up. So basically, I was behind for about 3 to 4 months, and then I was on par after that first semester and a little bit of hard work with all the kids who went to like private school or all the kids who went to amazing schools in like Westchester or Long Island.
Mhm.
So I think the takeaway is that as long as you maintain a good attitude and you're willing to put the work in, even if you go to like a relatively bad high school like Monticello, or I don't want to like label it, but it's not like Monticello wasn't like the best school, just like NFA, it doesn't have like a reputation for academic excellence when you compare it to like Westchester or Long Island. But if you are currently going through that situation, as long as you put the work in, then you will definitely catch up with all of the other kids who might have had a more advantaged background. So I worked really hard in Cornell. I've always been like very competitive, and I was very fortunate to get an investment banking job. I interned at Morgan Stanley, and then I actually I finished all my coursework at Cornell in 3.5 years because I took summer classes at both Sullivan County Community College and also at at Orange County Community College,
Yeah.
and it allowed me to graduate in 3.5 years. I then worked at CIBC World Markets in their industrial broking services in investment banking. And I don't know why anyone would go into investment banking. It's just like, it's such a horrible experience. Like,
Funny.
they just burn you out. Like, you would
Mhm.
work until 2 o'clock in the morning, and then you're expected to be in the office at 9:30. Uh, but much worse than that, they treat you so horribly, like you're less than human. And yes, like you are making really good money, and it definitely depends what group you're in. But my first group at CIBC World Markets was really, really bad. And I was thinking about quitting investment banking, but then I switched groups, and I eventually did banking for about 4 to 5 years. And then I was simultaneously working in nightlife as a promoter. And
Cool.
I was always interested in the stock market. And probably similar to yourself, I gravitated towards like trying to learn technical analysis and day trading, which I was never successful at. And then, I realized that selling options gives you a statistical edge. So then I started trading options, and then over time I started learning how to like manage and eliminate the tail risk, because even though you can win like 95% of your trades, that doesn't necessarily mean that you're going to be profitable if you fall into, or if you're unlucky enough to, get hit with like a black swan event, like, December 2018, February 2018, March 2020, etc. So, so yeah.
I do have a question for you. It's something that I spent a lot of time thinking about and talking with my wife about. It's just fascinating to me. You brought up, kind of your experience in high school and how you would like skip school sometimes and like go bowling and stuff like that. Why why do you think it seems to be, and this might be a little myopic of me, but it does seem to be a lot of instances where people who seemingly have a better starting point, they have like their own sets of friction points that are difficult for them to like overcome. Like if I look back at my experience, I would say, okay, like I went to NFA, not a good school. I should have, essentially done the same thing, whatever the case is, but kind of went down another path. But can't tell you how many times I come across people who seem to have these really advantageous backgrounds, whether it's affluent parents, go to a decent school, whatever it is, and then they still have like their own series of struggles. To me, it almost seems like if you grow up in an advantage scenario, that comes with its own disadvantages. Is that like something you've come across, or I always think about that to try to understand it.
I do think I think that I can talk about like for myself, and then I can also speak about like things that I've noticed, like especially like at Cornell, where there were people who
Right.
had a lot more money than me. I think for me, I've always kind of been like someone who kind of walks on the line, but sometimes I could like potentially step over it. And I think that as I got older, then I pull back. Like I'm married, I have children, and my wife is like really good. She's like the type of person where if she goes to Whole Foods and then my daughter like puts something under the carriage and she doesn't see it, she'll like freak out and then go back to the cashier and say, she'll like drive back to Whole Foods and say, "Hey, you didn't charge me for this." So I think it's just basically like in my own makeup where I kind of, I wouldn't necessarily say like I'm like a Rick James like habitual line stepper, but in the past, like, especially in high school, I would kind of like push the envelope and see like what I could get away with, just because I was always interested in like, analyzing like people's reactions and things of that
Mm.
nature. So I think that from that perspective, at least for me, I've always been the type of person, especially when I was younger, who was overly optimistic and thought, okay, like, yeah, I'll do that and I'll take the chance because things will work out. But as I've gotten older, I realized that relying upon luck and doing stupid things is a really bad strategy. And I've significantly cut back on and curbed my risk seeking behavior. As far as like other people, I do think that if you if you are born with a lot of things and your parents, or or whether you have one parent or both, if they give you things and they don't make you work for it, then you kind of, you don't necessarily recognize how much sacrifice is required in order to earn a lot of money. And if you're given things, then without having to build up that strong work ethic, then I think that that could be very detrimental to people in the future. And I also think that a lot of it has to do with luck. I mean, you have very brilliant people who have strong work ethics, and then they like hurt their knee playing basketball, then they go in for routine surgery, they get addicted to opioids, and then it completely destroys their life. So let's not disregard the luck aspect that success, that we're in right now. Like currently, like there are multiple paths that I could have gone under where, I might not be here right now. And I'm sure the same thing for you, where you might
100%.
have done some things in your past where, maybe you were driving too fast, or, you could have like gotten into a car accident, or something like that. Like luck plays a big part. But, I think for me personally, I've always been a little bit of a risk seeker, even though I'm not so much right now. But I also think it's very important, if I had to choose between outworking someone or being a little bit smarter than someone, 100 out of 100 times, I would always choose the outworking someone, because that's something that you control. That's in your own power. Whereas I know that my one of my friends, who is actually my roommate at Cornell, his name is Arby, and he was brilliant, like even by Cornell standards. But he he never really worked that hard. And he's okay, like he's like successful. He works at Capital IQ, but he definitely didn't accomplish his goals, and he definitely didn't accomplish like max out at his full potential. And he's brilliant.
Yeah, yeah, I agree with you. I think that unless you're in like a hyper technical field, the hustle can, I call it the hustle, but it's exactly what you're talking about, like this work ethic, this dog ethic that it can take you super far. It's like the same people that I meet. I have a couple friends from high school that started like construction. They didn't even go to college. You know what I mean? And they're doing great. And so exactly to your point, like being a little bit street smart, but I think work ethic can take you a really long way. I think that's an interesting.
And one quick thing before we get into like more so like options trading, in my opinion, I feel like intelligence is vastly overrated. I live in South Florida, and you can be a multimillionaire by opening up like your own HVAC company. Like the HVAC, I had people come here to service my HVAC units, my air conditioners, etc. And I paid them like $700, and I paid them via Zelle. So they're probably not reporting everything. So maybe they report like 200 or three hundred
Right.
dollars of that. But the reality is that if you have a very good work ethic, and let's say you don't necessarily enjoy like memorizing everything, or a lot of the crap that they teach you in high school, as long as you have a good work ethic and you learn a trade, you can become a millionaire very easily. You can work in, even like power washing driveways, or owning like a roofing company, or construction, or HVAC, things of that nature. You don't necessarily have to gravitate towards things that like society tells you are like very high social status, like working as like an engineer, or AI, or like trading, or things of that nature.
Well, you bring up a good point. I actually questioned my whole life's existence. I was watching a YouTube video by Caleb Presley. He does kind of like these fun interviews. They're called Sunday Conversations. And he did one with this girl called Bad Baby, who exactly as you imagine, she's an OnlyFans model, and she's from Florida, and she has like $100 million. And in the process of the dialogue, though, Caleb was asking her like, Florida, it's a peninsula. Like, what does that even mean? She didn't know what the word peninsula was. And then later on in that conversation, he asked her, like, oh, so you like reinvest into the business? And she essentially was just like, I don't know what that means. And I was sitting here thinking, like, God, where did I go wrong? I need to start an OnlyFans ASAP because I mean, obviously she has good work ethic, man, because she's made a ton of money. I was like, bro, yeah, to your point, a lot of times just being a hustler, it can take you a pretty far way, provided you're willing to put in the work.
The one thing on that is, it's always easy to look at the exceptions. You can say like, oh, this person made like $100 million and doesn't know like basic knowledge. But I think that for every one of her, there's probably like 10,000 people who actually are more attractive than her on
Yep.
on OnlyFans, who are probably making like a few $100s every single month. So for people who watch her, and then and also you don't know like what's going on in her life. Like maybe there are a lot of people who become rich, and I'm sure that it's pretty common knowledge that winning the lottery for many middle class people, or lower income people, for many of them it becomes like the worst thing that happens to them. They develop like addictions, like gambling, or drug addictions, and things of that nature. So I wouldn't be, and I know that you didn't say this in order to for us to say, oh wow, like we're envious of her, but I would just say that for every one of her, there's probably 10,000 people that are struggling. There always has to be like a Kim Kardashian or someone like that to like get clicks, or for the media to make a big spectacle out of. But you also, just because someone might have a lot of money, that doesn't necessarily mean that they have all their shit together. You just don't know.
Definitely. She clearly doesn't if she doesn't know what the fucking word peninsula means and she lives on one.
Yeah, yeah,
But yeah, you actually remind me of the book Outliers by Malcolm Gladwell. He talks
yeah.
about like all of those kinds of things, which I completely agree with. Still makes me super mad that she has $100 million. I went wrong, man. I should have opened an OnlyFans or something, but
How about we transition and talk a little bit about like our favorite preferred trading strategy?
Yeah, I think for trading for me, I really avoid the idea of falling in love with the strategy. The way that I think about it is I have a toolkit. My job is to look at the stock market and figure out the correct tool to apply. So, what that means is I have a grouping of strategies that I almost always run. So, like the first one is a covered strangle, which for the options traders out there, it's very similar to the wheel, but I have some pretty specific tweaks that I use with it. One of which I always run the short calls at a ratio to the long deltas. The second thing is it adds additional cash secured puts out. And normally I kind of double dip. So I'll have money tied to that trade. And then, I have portfolio margins. So the broker, they don't make it cash secured, right? So I
Right.
still have that excess cash available. And then I'll put that in like box spreads or something. Because right now, box spreads pay really well. They're like 5.4% annualized return. So it's a way to kind of, I call that my core allocation of the portfolio. And then in the speculative allocation of the portfolio, which is kind of exactly what it sounds like, that's where I'm going to be a little more focused on seeking specific opportunities. And for the speculative allocation, that's where I'm going to trade things like variance risk premiums. So I'm going to use short straddles, strangles, iron flies, stuff like that. And then the other big strategy that I use is ratio diagonals. Those are my directional strategies. It's either going to be ratio call diagonal if I'm bullish, ratio put diagonal if I'm bearish. And those really make kind of the broad ensemble of what I trade. If I'm trading volatility expansion, I still trade the straddles and strangles. Typically, straddles I would do, and I would just buy it. So
And do you,
sorry, go ahead.
sorry, go ahead. Do you
I was,
primarily trade on individual underlyings or SPY, SPX, or do you mix both of them?
yeah, definitely all of them. So
Okay.
it's, yeah, depending on the strategy. So like specifically, if I'm trading like box spreads, those are going to be in SPX, and European options are a really important part of the safety of that strategy, actually being risk free. For the covered strangle, that's almost always in an index ETF. I like IWM a lot for that. And then for the speculative allocation, sometimes it's in indices, less so, unless it's the variance risk premium trades. Otherwise, it's going to be in individual names more often than not.
Forgive my ignorance because I know that I've looked at IWM before, but which is that a sector ETF?
No, it's the Russell 2000.
Okay, Russell. Okay,
So it looks at 2000 small cap stocks.
okay. That's awesome. It seems like you have a plethora of like different trading strategies. And do they, I'm assuming that the answer to this is yes, but I also don't want to put words in your mouth. Does it vary your allocation on which strategy you use based upon like the implied volatility rank or what VIX is trading at or your directional or your like thoughts regarding the future direction of the market? How do they vary based upon like, where the VIX is trading or your perceptions of like where the market's going to be trading in like 30 days?
It's a great question. In a nutshell, the way that I dole capital out between core allocation and speculative first comes down to I'm going to try to make my primary returns, which for the longest time was 15% per year. That was my target. And I held that for like 12 years. And then over the last 4 or 5 years, I've been ratcheting it down considerably, just because I'm favoring a different return profile for the markets. And so,
Decrease to
right?
de- you're trying not to decrease your overall portfolio volatility as opposed to maximizing your return.
Yeah, that's exactly it. I'm not really looking to aggressively grow the portfolio at this point. I'm kind of content with where it is. I'm still growing it. And it's actually funny. This year was the first year that I guided myself down somewhere between like a 6 and 8% return. And when I just did my last YouTube live session, right now I'm like just shy of a 30% return on the year. So obviously it's kind of a different run for me. The way I think about that part, at least, is if I am at my targets, I'm just very cautious and selective on where I deploy, but I don't like stop, because who knows, like next year could be awful. So, but when I'm thinking between core and speculative, if I can make the primary return in my core allocation, that's great. And I'll run that at the smallest size I need in order to maintain my track to the annual target. And then the speculative allocation really comes down to opportunity. If I see opportunity, I always keep a portion of the portfolio open to speculative plays. But if I see a lot of opportunity coming up, I'll open up more of the allocation to the speculative play. So, like if we're going through an earnings cycle, for example, I have way more speculative trades on during that time frame than I typically would, and it's because I need a lot of occurrences in order for variance risk premiums to pay me out appropriately and to withstand, the eventual drawdowns.
Forgive me for speculating, but I actually like I know I can tell that you're like very, very intelligent. So I love this because um yeah, I just love like picking your brain and speaking to you about this. When you say speculative in the money, like speculative plays, are you referring more so to like buying like in the money call options, and that's been leading, or has that been like one of the main drivers of like the 30% return that you're currently tracking for? Or is there something else that this year has significantly contributed to like the outperformance that you've experienced?
Definitely the ratio diagonals. So, and it's the ratio diagonals are funny that way in that they obviously offer, directional leverage, and there's been no shortage of movers this year.
Mhm.
So, I think that that's been a pretty significant portion of it. And then also, just the prevailing variance risk premiums on this year have been pretty fat, at least fatter than we saw last year, which has allowed pretty reasonable performance. And then the other thing, in addition to all of that, is when I'm trading box spreads now, you have the ability to double dip money. So if I have cash allocated to the covered strangle, because again, the broker, they don't care, but I track it personally because I need to know where the money's going.
Mhm.
And so I'll have the money allocated to IWM covered strangle, but then I can still put it in something like a box spread and make a meaningful return on the money. Whereas, during COVID and really when I first started the YouTube channel, I wasn't doing many of that, right? Because rates were near zero. They would almost ask you to pay them to take your money. So I was just like, yeah,
Right.
this is a complete waste of time. But I think those three things coalescing together have really led to a very productive year. And there hasn't been like any sort of giant, sharp moves. And that's generally what slows me down is if one of those occurs and I get stuck in the middle and I have to work my way out. But most of the time, I'm very careful with positioning and watching market breadth. So for the last 2.5 weeks, I've been net short deltas in IWM, which is rare for me. Normally, I have some sort of bullish trade in there, but I've essentially rotated the position from a covered strangle. I just had cash secured puts out and I turned it into a ratio put diagonal because I just saw overall breadth changing and kind of following the market trends. So the fact that the market's rolling in these cycles is actually really good for me. I can trade those very effectively.
And one huge advantage of collecting premium and selling options is that, especially now where you have short-term rates at about 5.5%, you can collect that premium and then reinvest it in short-term T-bills or bonds in like
Mm.
3 or 6 months, and then you can collect, 5 or 6% every single year, which just last year you were collecting like close to zero. So that's amazing. And then
Yeah, and that's spot on.
and one more quick question about your, do you have like a target days to expiration that you usually like to that you typically like to trade around?
Yeah, it obviously varies quite a bit. So if I'm trading variance risk premium strategies, those are so if I'm trading like short straddles in SPX or if I'm trading earnings, those are all going to be 0 to 4 or 5 DTE.
Right.
If I'm trading the covered strangle, I have kind of a chart that I use based on just current implied volatility for IWM trending compared to historic volatility, and then how far we are off of near term highs. But for that, it's generally something between 2 weeks and 30 days, something like that in there. And then for the ratio diagonals, the long leg is pretty much always at least 90 DTE, vast majority of the time 180 plus. And then the short legs are typically around 20 DTE.
Awesome. As far as my trading strategy, I primarily look I have a watch list of about 10 to 15 stocks, and then I get comfortable with their recent trading range. And then when something I believe is overbought or oversold, then if it's overbought, then I'll sell a call credit spread that's out of the money. If it's overbought, then or if it's oversold, then I'll sell a put credit spread. Additionally, I do like to sell like 1 DTE options on the SPX. And furthermore, I'm very big on mitigating tail risk and reducing overall portfolio volatility. So especially during times when VIX is trading below 15, and I think just a few weeks ago it hit a low of about like 12 and a half. During those times, I will load up on put options in order to that will protect my portfolio for oftentimes years to come. And I know that it is very expensive when you're actually making that trade and buying like SPX, that it's like 2 or 3 years out. But at the same time, it provides you with protection when the VIX is trading at about 12 or 13, or even slightly higher, like 13 or 14, because you know that the VIX isn't always going to be trading below 15. It can go from trading at 12 to trading to 28 in like literally like 2 or 3 days. We've seen that multiple times. So that's basically my strategy in a nutshell. And that's actually helped me like during August, where the market, I think it's still down around like 4%. I've actually like outperformed the market by about 5% in total, where we're up this year. I think it's extremely, extremely important, and you hinted at this, not to chase maximizing your gains, because if you do maximize your gains without taking into account minimizing the tail risk, then you're always going to be at the whim of the market. And if the market's going up, then you're going to be doing well. But if the market pulls back, and there's a saying that the bull takes the stairs up, but the bear jumps out the window, you need to make sure that at all times you're protected against the bear jumping out the window, and you don't want to lose all of your hard-earned gains if the market has like a March 2020, because in March 2020, when the market fell, I think like 36% in 33 days, many people were forced to close out their positions only to then see the market rebound and recoup all of its losses in just like 2 months. But if you were forced to close out those positions because you traded too large, then that rebound is not going to help you. So slow and steady is extremely, extremely important.
Yeah, and you bring up a bunch of good points. I agree with you specifically on the idea of managing risk via size. I think I do think traders get too wrapped up in this idea of hedging, and they're afraid of variance and they're afraid of risk. And I think that a lot of times comes to their own detriment. Like when I was going through the phase of aggressively growing my portfolio, I was very frequently levered, like naked levered, where if the market took a crap, I would have been in huge, huge trouble if I did nothing. But that's kind of the beauty of trading options, is when we would inevitably get these kinds of down moves, there's so many products and so many ways that we can start offsetting risk very quickly once it starts hitting metrics. So I agree with you there, specifically on the idea of controlling risk. And even if you're levered, right, that's you can't be levered without controlling risk. Otherwise, you are going to blow up. It is literally
But
just a matter of time before a move happens that you're not ready for. And then you are in a giant, giant problem. One of the things I wanted to ask you is, you were saying that you were hedging your portfolio with SPX puts. And I'm curious, why do you use that as compared to something like VIX or like VIX futures or something like that?
I primarily like SPX because it offsets some of the 0 and 1 DTE trades that I make. So from
Mhm.
a portfolio margin perspective, it does help with that. Additionally, with VIX, because from my understanding of VIX, it's essentially like a math equation where you know that if VIX is trading at 30, then it's only a matter of time where it's going to then contract and there's going to be a volatility crush more so to the mean. I actually, one part of my strategy, which I really like doing, is when VIX is trading over 30, I will sell calls on VIX with, a 30 to 60 day or even 90-day expiration. But in general, I prefer buying the SPX long dated options just because it's something that one, there's a lot of liquidity. Also, you can go as far as like 5 years out. And it's just something that I feel comfortable with. I've been doing it for a while, and maybe it's just a habit. But
Got it.
you can definitely hedge with VIX as well, because but also remember that when you're buying those puts in SPX, there is obviously like a large VIX component because the option pricing is going to be factored in. And the VIX measures the volatility on the SPX. So whether you're hedging with VIX or you're hedging with SPX or SPY, it's extremely highly correlated.
Yeah, definitely. And that's actually why I bring it up, because for people that are buying really long-term protection, against the portfolio, if you're beta weighting your deltas, going with volatility a lot of times, again, to your point, if the VIX is elevated, it's not a great time. You're already too late. But if the VIX is not elevated at that point, it's actually, I would say, a more efficient trade than going with long SPX puts. And it's specifically because if you buy SPX puts, let's say, SPX is trading at 43.87 right now. And let's say over the next 4 months, it trends up, it trends up, it trends up, it trends up. Now the deductible on your puts it's now massive,
Mhm.
because the distance between where you entered and where it is now is very different. Whereas that's kind of the beauty if you use VIX volatility of some sort, if you're beta weighting your deltas, because if you get in when VIX is 15, if the market trends up, trends up, trends up, the VIX is still at 15, maybe
Right,
14, maybe 13.
right. Yeah, there's
Then
always
whenever
going to be a floor, especially
exactly.
like
Yeah, so
maybe
you
the floor is going to be like around 12. I mean, I've heard the VIX has gone below 10, but it's never there for an extended period of time.
Yep, exactly. And so it's just, I found that actually adds a lot of um, efficiency behind the hedge, because then you don't have to keep sliding it up and eating a loss in order to maintain your deductible on the puts, especially if they're longer term. So yeah, just throwing, ideas out there, because I tested both of them pretty extensively. And in general, I actually really prefer the VIX. Yeah,
So
using VIX futures.
as far as hedge, okay, so that's funny. Okay, so VIX futures, and you would prefer VIX futures as opposed to buying long dated VIX calls, like in the money calls?
You do either. Yeah, I would argue either is completely fine. It really just comes down to the size that you're trading, and what kind of protection you're wanting to outlay for. And I also, one of the other things that I do talk to people about, if we do use VIX options, specifically calls, is you can even enhance your risk profile pretty significantly. If you start with in the money calls, to your point, that will provide the primary hedge, but that you can add some teeny options, some kickers that are really far out of the money. They're low extrinsic value anyways, right? So theta decay is going to be inherently slower no matter what, days to expiration and being far out of the money. But then those can compound really quickly, and they can actually pay out like pretty damn nice in a big pullback. So yeah, I think
Those,
combining both of those is actually really slick.
those would basically be like lottery tickets, right?
Not in this instance so much. Like they're really a hedge, but to
Oh
your
no.
point,
Did
it's
we
like,
did we
oh,
get
sorry.
disconnected?
Let me pause. All right, we got disconnected quickly. I guess Zoom got too excited about us talking about VIX calls, but we're back at it.
Yeah. So my question was when Eric was discussing like buying those, so I'm assuming like those out of the money VIX calls, then they would essentially act as like lottery tickets. Is that correct?
Yeah, it's. I guess it depends on what we mean by lottery tickets, but yeah, it would serve as a highly compounding portion of your hedge, is the way I would think about it. So if the VIX is trading down at 13, and then you buy, let's say, we could look at the VIX right now. And so if we go out 238 days and you buy some teeny options that are down at like 10 delta, or 50, you're gonna pay what, like a few dollars, if that. But if you get the move that we're trying to protect against, those obviously compound very quickly. So they can, in a big move, they can actually really enhance your overall hedge. But to your point, I still think the primary portion of that hedge is going to come from the deep in the money, because that's going to move dollar for dollar faster. So whenever I'm hedging with something like that, I almost always add the teeny options, because they're cheap enough. And if you can get the compounding, they pay for themselves for the next 4 times you run them. But yeah.
And then for our viewers, if you were going to trade the future, I believe that you would have to trade /VIX. And if you were going to buy the option, I think that the preferred way would be to trade VXX. Is that accurate, or am I incorrect?
So for VIX futures, it depends on your platform, but for like Thinkorswim, it's /VX, not VIX.
Okay.
And then for options, you could use VXX or you can use VIX. It really depends on your preference between the product tracking. I think I've had good success with both of them. The other thing you can do that I've gotten kind of cheeky with before, and if you want to be efficient, is you can use a levered ETF. The downside
Like
of that is
UVXY or SVXY?
exactly,
Yeah.
exactly. The downside of that is there is drag,
Yeah.
but the drag on those returns, it's so overplayed by people that completely write it off as you can't ever hold these for longer than a week because the drag is so bad. And it's really not. That drag simply materializes as tracking error. So if it says if it's, 3 times levered, the move you get is like 2.6 times. Not quite that 3 times. That's the drag you see.
So
So
I think
yeah, it's just another way to do it.
for UVXY and SVXY, I think they actually like reconstituted or recalculated it on like February 5th or February 6th, like 2018. Because I
Oh, I
remember
see.
I was flying to Cartagena, Colombia with my wife, and then those like I forget whether it was UVXY or SVXY. I think it was SVXY. It basically like blew up. It went from like 140 to like 12 in like an
Mhm.
afternoon in like 4 hours. Um, so yeah, so yeah, like using those, but yeah, now it's a lot more stable, and I think that the drag is less. But I'm definitely going to. I definitely appreciate your thoughts because I know that you've done like a lot of research on the pros and cons of SPX versus VIX. And I think just without me like doing a lot of research, it does make a lot of inherent and intuitive sense where you know that the VIX, if it's at 15, yes, maybe it drops to about 12, but you know it's not going to drop to about like 6 or 7. Whereas with the stock market, you actually don't necessarily know where the bottom is going to be. So you are inherently protected if you buy those in the money long dated VIX calls because you know that like if you buy it around 14, then you're buying close to relatively close to the bottom, even if it drops like 12 and a half, like it did a few weeks ago, but right now it's trading at about 17.
Yep, that's exactly right. And the beauty is, as we know, the market exhibits positive drift. It's just way more efficient because you don't have to keep managing it to, manage your deductible. When I'm saying, for the viewers, when I'm saying manage the deductible, again, if you buy puts for $100 when, SPY is trading at 110, just for simplicity, and the SPY now rallies up to 190, well, the protective power of those puts has decreased exponentially. You have a huge drop and they're now a giant loss. So you have to roll them up to maintain your protection, and it's expensive because you're doing it at a loss, outlaying more money. So it's a way to go around that, but it is important to understand that it is different, right? So
Right.
if you're trading products, making sure that you're tracking the tracking error, because if you do use VIX calls, for example, the SPY can have a 4% drop and the VIX calls might not even respond. They might
Right.
not even wake up. So the idea of using the,
Especially if
VIX
VIX is
options.
especially if VIX is already elevated, the market can drop like 4% over a week and you can see VIX not even move at all.
Exactly right.
It
So
happened a lot
if
last year where VIX was
exactly.
trading like close to 40 and then the market would, yeah, that's
Yeah. So, and that's why it's important. It's not like a one size fits all, always do this, but it is if you're looking for protection, it's like the same thing, right? Like the best time to get a roof repaired is when it's not raining. Same
yeah.
exact thing when you're buying portfolio protection.
Another advantage that I can see is because of the low cost of VIX, you can get much more granular where you don't necessarily have to spend thousands of dollars on SPX or even like hundreds of dollars on SPY because VIX, if it trades at like, 12 or 13, then it allows you and affords you the opportunity to be more granular and to hedge off some of the risk. And,
Yeah.
without investing tons of money on like SPX or even SPY.
Yeah, and I honestly I normally turn it into kind of its own little trade. Like if I'm buying, let's say for example, deep in the money VIX calls, I'll sell short calls against it in VIX, shorter term time frame. I just keep it at a ratio, right? Because otherwise you get rid of your protection, you're fighting yourself. But it is a really, again, easy way to kind of subsidize some of the long-term holding costs of it. And to your point, if we're doing it right, we're going like 80 delta plus, we're super far in the money. Theta decay is small. Overall theta, extrinsic value of the options, is small. So you don't necessarily have to do a bunch of short call campaigns to cover a meaningful portion of the cost. You just have to
Yeah.
be super careful to do it at a ratio. Otherwise, you cap your upside potential or even induce upside risk. That's not good, right? Because now you're literally just losing on your primary position, losing on your hedge. We've now just completely undone that.
And when you sell the out of the money calls on the long calls that you on the long in the money
Mhm.
calls, I'm assuming that you're going like somewhere like 7 or 14 days out, right? In order to
Bingo.
collect some premium. Okay, that makes a lot of
That's
sense.
Yep, that's exactly right. So essentially what I'm doing is I'm just turning it into a ratio called diagonal and just using the offsetting deltas to manage
Yep.
broader beta weighted portfolio risks.
And the interesting part of that is because the deltas are so different, where you're buying the high delta in the money call,
Mhm.
you can actually sell a little bit more out of the money calls. I wouldn't go crazy with that, but if you let's say you bought like five in the money calls, you can actually probably sell like eight, maybe maximum of 10 with a shorter duration, because you know that if VIX spikes up, you're going to profit dollar for dollar on the long calls, whereas you're not going to lose nearly as much on the out of the money calls that you sold. So
Yeah,
yeah,
it's I
it's interesting.
I definitely would consider that to be ultra risky in the concept of a hedge, right? Because
Yeah.
then we definitely would induce upside risk, but as a standalone position, I think that could absolutely work just fine.
What are some mistakes that you see new traders make?
I think it's two things, pretty simply. I think the first one is approaching trading as a hobby. And then the second one, I think, is having busted up expectations like we all start with, right? We all want to get rich fast. And that reads typically leads to getting poor fast. It does not work well with the markets. And then definitely, I think trading is probably one of the worst possible endeavors to approach it as a hobby. It is nothing but a pretty surefire way to lose money.
I think for me, to kind of echo what you said, I think sizing is really important, and also expectations. I mean, we all see on YouTube where you have a bunch of creators who try to create clickbait and say that they can turn like $500 into like $5 million. And when you have someone who's like really young and they have a little bit of money, it it attracts them, and they think that they're going to be able to buy some really far out of the money call options on meme stocks and turn like $500 into $50,000. But I think that it's very important for people to play the long game and to build really good habits. And I'm sure, that you would probably agree, especially as someone who went to the Marines, where habits are basically everything. Like they tell you that you have to make your bed, that things have to be spotless, because they want to groom you to make sure that they mold you into a great person in the future as well. And if you're the type of person as a new trader who's going to take low probability trades that has an expected probability of profit that's going to be significantly negative, then you're not really teaching yourself anything. Instead, you'd probably have a better time playing blackjack or roulette at the casino as opposed to, gambling in the stock market.
I agree with you, and I think that I like to say habits are who you are. If you have somebody who's undisciplined in their diet, I can guarantee you, if you look at their life, they're undisciplined in other areas. It's the same thing for trading. Like if somebody is an undisciplined trader, I can look at other aspects and probably identify where they're also not. I do think the idea, the idea of integrating different payout profiles, I think, has been one of the most important things. And this is actually something I would be fascinated to kind of understand more of your perspective on, because when I was trading a lot of vertical spreads, I did not make a lot of money. Like, especially after including costs, it was a lot of work and not a lot of payout. And I think one of the things that I would encourage option traders specifically to do is to not fall in love with buying or selling theta gang or vega gang. Like, don't get too wrapped up in an individual camp, because if one style of options trading had an inherent edge that was extractable long term, everybody would
Everyone
do
would
it.
do it. Yeah.
Bingo.
Right.
So,
Yeah.
and I like that you integrated, because like I know that you were talking about trading spreads a little bit and verticals, and it's definitely not my go-to, but it can be done successfully. And I also like that you integrate ideas of creating a range, right? Because now you're overlaying some discretionary components to it that absolutely can increase our efficacy. But I'm curious, what has kept you with vertical spreads versus kind of venturing into other stuff?
Well, I think that with spreads, I actually don't. I would choose a strike on the short put side where I actually don't mind taking ownership of it. So on one of my
I see.
accounts, I'm using portfolio margin so I could trade a little bit larger. And then in the
Mhm.
worst case scenario, because I'm trading on very highly liquid large cap stocks like Amazon, where if I sold a spread on Amazon, let's say it's like 90 by 80, and I know that last year Amazon hit a low of like 82. In that situation, I'll actually take ownership and go long Amazon just because I feel like, on a net basis, being long Amazon at 88, where just like a few months earlier it was trading at like 185, then I think that the risk to reward from the upside perspective is pretty damn good. So I'll sell spreads and then I actually don't mind taking ownership of it. And also, because I will sell spreads on things that I perceive to be oversold, then the implied volatility rank on that specific underlying is actually higher because the stock has fallen from where it was previously trading. So therefore, I'll collect a little bit more premium. And I would say spreads comprise about like 30 to 40%. Similar to you, I will integrate different strategies based upon like where volatility is, how much credit I'm receiving, etc. So I think it's just one of the strategies that I'll use, but it's not something that, but I agree with you, especially during periods when volatility is low. And if you're using regulation T margin, and if you're trading something which, which is a pretty narrow spread, then oftentimes if you're picking up like 25 cents or $25 for every contract that you sell, and when you factor in commissions, oftentimes it's not really worth doing. So you have to make sure that you have multiple strategies at your disposal.
Yeah, I agree with that. And I also like the fact that you trade spreads semi discretionally and directionally also makes a little bit more sense to me in terms of just including a floor because I see people who trade, the theta gangers, they trade verticals. And I tried to like conceptualize why this would make any sense because their whole premise is we're selling premium because it's overpriced and it's high, logical, but then they're buying it. They're buying the very thing that they're selling because it's
Right.
high and they're buying something that's too expensive then. So that part confuses me a little bit, but I see definitely more of the way that you're employing it. It's interesting to me.
One of my close friends on YouTube, he's kind of against like using any type of discretion in your trading. And
Mm.
I never necessarily understood that. It's kind of like oftentimes people think that, and this kind of goes into what we were discussing earlier, or like on email, and we're going to touch on it in this call as well about like AI and bots. I do think that it is important to have some discretion in your trading because if if you don't have any discretion, then just like you said, you're really not going to be collecting that much premium and you're not going to be able to know when to allocate and when to use different strategies based upon the market conditions. So I know that discretionary trading or using different strategies at your discretion can oftentimes be looked down upon, but I think that it's worthwhile. If you have something like earlier today, I made a trade on BlackRock because BlackRock, it was trading. At one point it was trading over 900, and recently it's been trading around 670. So I think that selling a vertical credit spread with like a 520 by like 460 is not that bad, considering that in the worst case scenario, I can roll that position into a naked if I wanted to take ownership, roll it down to like 460, and then simply take ownership of like 100 or 200 shares. And I think that from a long term perspective, that's not necessarily a bad trade, considering that I would be able to take ownership of BlackRock at less than 50% of where some people had previously purchased it. But we don't know. Like BlackRock can fall below 300, but I think that statistically, the odds of you know of taking ownership and owning BlackRock at like 460 to 480, that's not a bad trade.
Well, I also think that's the whole point of you doing the spread, right? Because it includes some sort of risk management inherent, because to your point, like if you were trading it as a cash secured put, you wouldn't put the spread. You would just trade the
Right,
cash secured
exactly.
put, you would make more money. But I think that by you trading those kinds of things, that spread at least gives you some optionality. And to your friend's point, I find that fascinating because I think without discretion in trading, there is essentially no alpha. Like I don't see a retail available automated trading approach that can produce alpha. I'm open to it. I would love to. I genuinely would love to. I would pay for it if it
Yeah,
existed. But I genuinely do not believe that that's going to exist probably at all. And it's again, as soon as that exists, I would buy it, I would lever it, and then that's it. I'm not so attached to the art of trading. What I tell people is like, I'm a businessman first. I'm here to make money. So
mhm.
if there's something that can make money more efficiently than I can, I wouldn't be like, oh, but this is what I do. And this is who I like, screw all of that. If there is this non discretionary system that is reliably profitable, I would 100% use it. So yeah, it's interesting, but also to your friend's point, and the reason why discretionary trading gets looked at down on a lot, I think, is because there's levels to things, right? Like if you do jujitsu, there are certain moves that are looked down upon for new people, and it's because they dork it up all the time. But for the seasoned people, they do it all the time because it's effective. I find the same thing with discretionary trading. The reason why I think it's looked down on is because most traders take that to the extreme where they're just shooting from the hip, man. Like they have no plan, they have no logs, they have no way of tracking and optimizing, and then they wonder why they fail. So yeah, it's a really fascinating part of trading, I think.
I think I agree with you 100%, and I wish that someone would prove me wrong. And maybe in the future, we will be proven wrong, that they'll be able to remove the discretion from it. But I don't think that it's where it is right now, where you can program a bot or an AI. And we'll talk about this a little bit later. But I don't think that AI and bots and removing all the discretion is where it is, or is where it needs to be right now in order to have it produce alpha. And I do believe that some of the reasons why people want to remove the discretion from their trading is because if you remove all the discretion and then the trade goes against you, then suddenly it's not your fault. It's the fault of the rules or the fault of the bot. But suddenly, like you're absolved from any responsibility. Oh, it's not my fault. It's the bot. It's the robot. It's the rules that I programmed it with. So hey, if you want to earn alpha, if you want to make money, then I do believe that taking personal responsibility and owning it and educating yourself and making the right decisions is probably your best way of actually achieving that.
And I think what you said earlier before we started recording also holds really true here is like, who doesn't want easy money?
Yeah.
I want easy money. Like it really sounds good to me. So the idea of being able to program rules into a bot and let it go make money for you, it sounds very easy. And I think the idea of like these rules based or systems based trading, it's so funny. It's nefarious because it sounds really intellectual. It sounds so smart. Why wouldn't you want to cut out the human emotion? Why wouldn't you want to cut out the variance in your execution? Like that sounds super smart to me. But unfortunately, that last part where we actually apply discretion, again, in my opinion, that's where alpha is. Otherwise, I would program the same exact robot, man.
Yeah. A few things before we wrap up. I want to talk about zero DTE. I want to briefly talk about, although we kind of already did, like AI and bots, but we can touch upon that a little bit. And then you have a very unique perspective, which I didn't used to agree with, but now I do agree with about rolling. So I also want to share that with the audience. Can you share with me like your thoughts about like 0 and 1 DTE trading?
Yeah. It's a tricky place to operate. So in short, there are a lot of opportunities in that space. In long, the vast majority of retail traders lose money in that space. And it's not what I always encourage people to check out is SSRN. It's a place where you can find peer reviewed studies on all of this stuff. because I have a like really comprehensive data set at this point, to be honest, because I've been tracking for 15 years now. However, I always encourage people like, I'm just a dude talking on the internet. You in no way should take what I say as some sort of law. You should look up peer reviewed work on this stuff. And there is some really, really, really great zero DTE SPX studies on this exact thing. And I have a couple videos that talk about it. But the punchline is, once you get through essentially when zero DTE options were launched, which was what, 11 May 21 or 22. And after that time frame, when we had daily expirations essentially, and in that time frame, retail traders were profitable net fees for about 4 months. And then once we look, both net and gross P&L, it's huge down, huge down. So I think that it's an interesting place to play. There's a lot of slop in the pricing, which is
Isn't
something that I don't think retail traders fully appreciate.
isn't a lot of the reasons why, and I think I've read some of the research reports, a lot of, in my understanding, please correct me if I'm wrong, because you're more educated about this than I am, but a lot of it has to do with the slippage and the commissions that comprise the vast majority of their losses. Is that accurate, or am I incorrect?
That's exactly it. And so there's a study that's actually like really recent that I like. It's called Retrade, and I'll give you the link to it too, just so that people can check it out. But it's called Retail Traders Love Zero DTE Options, but Should They? And it's by Beckmeyer, Branger, and Gata. This was done in 13 April 2023. And it talks about literally, quite literally, exactly what you just said, because retail traders have actually gotten okay at integrating aspects of volatility assumptions into their trading, which is positively predicting. That's a good thing. However, even now, once you look at gross returns, they're not doing a good enough job at it. So they're getting that part wrong. And then once you add net, we start adding the fees, it's massive, massive daily losses. I think retail traders using slim options, meaning I'm not sure if you're familiar with the process, but it's like a price improvement process for 10 lots or less. So you can kind of typically identify retail traders in that space. And of those options, like there's $133,000 being lost every single day by retail traders in zero DTE options doing that in the aggregate. So it's just a massive, massive perpetual loss that they're facing. So I think they're good and I think they have their place. I like them, but I always remind people it is a minority of what I do. It might be 5%, 10%, maybe of my total volume, but there's opportunity. But yeah, it's very tricky.
Right. And what are your thoughts regarding rolling? I think this is very, very valuable.
Rolling to me it's fake. It's a fugazi. It doesn't mean anything. I think retail traders essentially deploy it as a way to avert losses. That's a giant behavior of retail traders is loss aversion.
Yep.
And what I try to explain to people is rolling is super simple. We close a trade and we open up a brand new trade. That's what a roll is. We're simply attempting to tie the accounting to one another, but none of that matters in any material way. Your broker doesn't care. Your broker includes it because you like it, and their job is to perform a service. So they're like, retail traders like the idea of rolling options, and sure, it does add some simplicity here and there. I roll options, to be very clear. I roll them, but I am under no confusion that typically when I'm rolling an option, I am closing a trade for a loss. I am realizing a loss and I'm opening up a brand new one that could overwhelm the loss of the previous trade. But there's a big difference between realized P&L and unrealized P&L. So yeah, rolling trades, super simple, closing a trade, opening up a new one.
I think your video on loss aversion and rolling was one of the better videos on option trading that I've seen in all of YouTube. And
Oh, I appreciate
if
that.
I'm definitely going to, hopefully I remember to link to that video in the description, because it was amazing. I definitely think that rolling has a little bit to do with people's ego, where especially when you're selling options and hey, I do it myself. I'm like, oh, you can win up to like 98% of your trades. But the reality is you have to be completely comfortable losing that 2 to 5% of your trades, and almost to counterbalance the psychological dependency that we have, or the psychological fallacy that human beings are cognitively biased towards for the loss aversion. It's almost like we should be loss seeking if we have a bad trade go against us to counteract that loss aversion. It's almost in your best interest to be loss seeking, where if you have something go against you, it's completely okay just to close it out, take a small loss, and recognize that you'll make it back on your next trades. But where you won't make it back is if you add increased risk to that trade, you increase the number of puts, or you increase the number of calls if your call side is challenged, and then you turn a small loss into a big loss. Because you can still win 95, 98% of your trades, but if that 2 to 5% of your losses are, if they overwhelm your gains because you didn't want to simply accept that loss, then you can actually end up losing money by trading options, even if you have a high win rate.
It's such a powerful way to frame it, but I couldn't frame that any better myself, that we should be seeking long.
Yeah.
The way
Seeking
that I
loss.
think Yeah, the way that I think about it is the vast majority of successful traders that I know, they might win about 50% if they're good. The idea of these really high win rates is exactly to your point. It appeals to two things. It appeals to ego,
Yep.
and it appeals to loss aversion because we're scared of losing capital. But what I try to remind people is that I would rather win 51% of my trades, but manage risk well and have a good return than win 90% of the trades and then after friction not have any money to show for it. I Yeah, being wrong quickly is a really good methodology. And the other thing I'll add to that quickly is just the way to kind of embrace that, I think, is to not take losing trades as some sort of like value assessment of you as a human being. If you have a
Yeah.
losing trade, it doesn't make you a loser.
Yeah.
You
You're
had a
not a
losing
failure.
position. You had a losing position. If you play
Yeah.
basketball, you're going to miss some shots. It
Right.
happens. But the idea is, in aggregate, does this make sense? Do we have positive expected value? That's what matters.
Your video, like I said before, was amazing. And the biggest takeaway that I took from your video, because you really hit hard into like the fallacy, the psychological dependency upon loss aversion. The biggest takeaway that I took away from that video was, man, I should really be risk seeking. I should actually lean into my losses and the trades that I feel uncomfortable about and which are showing me like a 3x loss of like the credit received, instead of hoping that they're going to turn around and that they're going to show me a profit. It's actually in my best interest to just simply close them out and just move on. Be loss seeking. That was the biggest takeaway that I took, because you almost have to overpower and overcorrect for the inherent psychological for the inherent psychological, like whatever the word is, but the psychological fallacy that you have to be lost for loss aversion. You almost have to overcorrect for that in order to overcome it.
I completely agree with you, and it takes a while because all of those undertones exist, and a lot of it comes from healthy detachment of capital, all those kinds of things. But exactly to your point, I have losing trades very frequently, and at no point do I look at them and say, "This is it for me. This is the end." And a big part of that is if you're sizing trades efficiently, and if you're deploying in a broader system that has positive expected edge in the long run, losses are part of the game. It is just part of the journey. It's like, again, if you do jujitsu, you're going to get tapped out. It's going to happen. You're going to lose. But the idea is to get tapped out quick enough so that you don't break anything, and then you learn and move on.
And the final thing, which we touched upon earlier, regarding your thoughts for like AI and bots and removing
Mm.
discretion, I echo what you said earlier, where I just don't think I think that everyone wants to make easy money, and they want to remove the discretion, they want to remove the decision making process, because therefore it's one less decision they have to make. Because hey, look, making decisions can be stressful, and we're all overwhelmed and overworked, but I don't think that right now I can't tell the future. So maybe in the future, the technology will improve, or what you can do with building out the bot, et cetera, might potentially improve. But in my opinion, I just don't think that it's worthwhile right now. And you made a great point when you said that the alpha is in the discretion and in the decision-making process. So, what are your, I kind of summarized
Yeah.
it, but do you have anything to add?
Yeah, no, I think you nailed it. I think it's important for retail traders to respect and understand how professionals and institutions operate, but part of that is to clearly understand the difference in our structure. So one of the big things that institutions, and that includes market makers in this kind of parlance, is they have a giant leverage benefit that we don't have and we'll never see. And essentially that allows them to offset a lot of risk as they're making books and as they're managing their broader book. And obviously they have much less friction than we do. So the idea of high frequency trading or arbitrage, where we're finding things that are mispriced and then pricing them back in, it's accessible to those people for those reasons. And I actually think it's good for retail traders to try to mimic what's successful. If you want to be good at jujitsu, you should look at what Gordon Ryan is doing and try to pick up something. It's the same thing for retail traders. However, you're not Gordon Ryan, right? So like you have to acknowledge some of the differences between the two. And I think that's important for retail, which is exactly what you were, the idea of like tinkering with and playing with AI or automation parts of your trading is smart. I automate parts of my trading. I scan. That's automation. I plug in rules that apply to my strategy to quickly just run through a bunch of stuff to reduce what I have to look at. I automate parts of what I do.
To find
But
opportunities. But then,
but
but at the end of the day, you're the one who is sifting through. Let's say there were 1,000, and then you use a scan in order to narrow it down to like 20 or 30. But then you choose what you perceive to be the best, like three or four, and then you make a trade out of it, right?
that's exactly it. And one of the things
That's what I
that, yeah, one of the prevailing traits of successful traders long term, again, I encourage you, the study's called The Behavior of Individual Investors. It's an older one, but it's fantastic. And one of the traits of successful traders is pattern recognition. It's our
Mhm.
capacity to look at data long term and come up with different assumptions. And the cool part about pattern recognition is once you do it for long enough, there's a giant subconscious component to it where you look at something and you might consciously be saying, okay, the moving averages are doing this, the linear regression channels are doing this, but your mind is running through the Rolodex, man. If you look through thousands of charts, it's overlaying and looking for patterns subconsciously, which is such a powerful mechanism. A lot of times that manifests itself as, that's the pit of my stomach. I'm following my gut here. Something feels weird. Believe it or not, your stomach is not telling you jack shit. That is the subconscious processing part of your mind that is just filing down tons of information and giving you cues that you may or may not realize are there. So yeah, pattern recognition is massive.
I think pattern recognition is extremely important in everything that you do. If you look at someone like LeBron James, one of the best basketball players ever, whether you think he's ahead of Jordan, like one or two, he's one of the best. If you listen to him talk, he has the ability of remembering specific plays even from 10 or 15 years ago. And because of that, even though he's older now, I think he's about like 38 years old, he's able to position himself and make the right basketball decision where even though his physical characteristics have declined a little bit, he's still a top 10 player in the league just simply because of what you said, pattern recognition and being able to distill tons of information down to its most important takeaways where he can actually act upon it and use it to benefit him. And there's really no difference about what he's doing versus what we're doing as traders, where we're looking at
Right.
patterns, we're looking at the best opportunities, and then we're acting upon it to hopefully achieve alpha based upon our experience.
Dude, literally a beautiful summary. Completely agree.
Awesome. So honestly, this was one of the better chats that I've had. I think that you're brilliant. And I actually didn't know that we grew up in like the same area of the country. I think
Hilarious.
that's amazing. I would definitely like to do this again in the future. So I'm going to link to your channel, and
Mhm.
I'll post this, probably in around like early September. And guys, definitely follow esInvests. I'll link to his channel below. And then for Eric's viewers, my channel is beststockstrategy.com. If you guys enjoyed this, then please leave a comment below. I would love to do this again. And thank you so much for your attention. Eric, do you have anything else to say before we wrap up?
No, man, stoked. Had a blast chatting with you, and thank you for the time.
Thanks again, guys.
Awesome. Take care.